Hi, good afternoon to most of you. Good morning or good evening to people who are joining us from other part of the world. So this in this session we are going to talk about ESG, and let me introduce the two people who join me in this conversation before I start on my opening remarks. Imoni Pofure, um, she is a non-executive director of the Guarantee Trust Bank and a trustee of the boards of engineers in Business Fellowship. She also serves on the investment committee of Africa 50 and the Fund for Agricultural Finance in Nigeria. She has over 30 years of experience as a finance and sustainability professional in both developed and developing countries, and particularly in Africa. Of course, when I say 30 years of experience, I should also qualify that she started working at an early age. Welcome. Welcome, Imoni. Thank you for joining us. And the second panelist who is joining me is Shamila. Shamila is the Chief Sustainability Officer at the Johannesburg Stock Exchange. And as a sustainability specialist, she has been a key contributor in the stock exchange research into climate change, the potential for local market to trade on carbon credits and environment-related products, the development of the green bond framework, impact investing are other areas where she has worked on. She's also a trustee of the WWF South Africa, and in her previous experiences before this role include senior roles in the banking and the insurance industry. So thank you, Shamila, for joining us. So I think the way we would be conducting this session is that I will start with a bit of opening remarks, and I would use the help of a couple of slides for doing that. So I'm going to share my screen over here, and I hope that's kind of visible. So sustainable finance, the new normal to access to capital. Now, I start with a picture which made the headlines during the period of COVID. And what I'm trying to say here is that once this wave goes through, the others are gathering strength. The economic recession, climate change, and of course, there is a bigger one behind that as well, which is the biodiversity collapse. There has been a lot of comparisons between climate change and COVID, or COVID and climate change. But let me tell you, there is one big differentiator. We have vaccines for COVID, but for climate impact, there are no vaccines. So, do we still believe that these events are black swan events? I don't think so. I would qualify them as the gray rhino events, and I know people from Africa would really relate to it, which is charging towards us, and we have chosen to ignore them in the past. As can be seen in the risk landscape, every year the World Economic Forum puts out, these things have been kind of predicted well in advance, in the sense that people have been talking about infectious diseases right in 2015 when the SARS, and of course in Africa as well, there has been diseases. So I think it has been there. And it has been on the top of the risk register, whether it is extreme weather events or climate-related action or climate action failure or human environmental damages, biodiversity loss. It has been in the risk radar for quite some time. But I think it has been ignored for quite long. And what is currently happening, or what the realization happened in 2020, is to bring this to the focus. So I think, sometimes talking too much about risk doesn't convey the importance of something. And maybe especially in the financial world, it might be good to speak about opportunities as well. And the way in which the whole of this topic around sustainable finance turned around in 2020 is a big opportunity as well. So let me give you a couple of graphs to showcase you the kind of the opportunity landscape. What you're seeing here is a S&P 500 research. On your left side, what you're seeing is in terms of the equity PE valuations, and where they compared the companies who are ESG leaders and in the same sector compared them with ESG laggards. of the sustainable leaders or sustainable laggards. And you can see there is an upside of about 20 to 30% for the valuations. And this is not just at the S&P 500. Now people can say that it's different in different parts of the world. It's not. I come from India, and I can see the same trend here. The ESG index is really outperforming the normal index, and or sustainability score. They have a differential in terms of almost about 200 basis points. And this is also something which is evidenced. And as we go along, we'll speak about products where we are seeing this difference. The manner in which the whole market is evolving, you would have seen in terms of the green bonds, sustainable bonds, social bonds, green loans, sustainability linked loans, bonds. Only in February in India, we bonds. And I think it's happening in Europe. We have seen a number of sustainability linked bonds, the same across many other places as well. Bond. So I think it's all across. And I think we can very clearly say that this is happening around. So how do we kind of capture this wave which is over there? This is going to be the topic that we will discuss today. And clearly the business case for the financial institutions, which is very clearly coming out that this is an opportunity for you to enable access to capital, reducing your potential vulnerability, because the kind of exposure you might have through your investments, how do you reduce that vulnerability? And also how to integrate. So today's key aspects of the discussion which we are going to have.
Santosh, we seem to be losing you. Maybe you want to stop sharing your slides?
Yeah. So am I audible now?
Yes.
Okay, sorry.
Yes.
Okay. I do not know where I lost. I was in a continuous this thing. So can I see you guys as well? Yeah. Okay, good. All this happens in a tech-savvy world. Okay. Is the screen off now?
Mm-hmm. Yes.
Okay, good. So I think let's get started. And, I usually tell many people that the whole of this COVID crisis resulted into what we call as a, sustainable finance 2.0. Earlier to which, whenever we talk about sustainable finance, we used to talk about, do good, goodwill, reputations, and those kind of things. But I think there has been a complete shift in terms of the way in which this happened. So Shamila, maybe I should start with you as to what has changed in this ESG landscape since the beginning of this crisis, and what changes you are witnessing in terms of investment flows, the products, and all those things, and focusing on the African side as well.
Hi, Santosh. Thank you very much for that. And thanks for having me, and to the organizers as well for inviting me to speak today. It's an absolute pleasure to join you. I just want to check that you're able to hear me clearly. Are we good?
Yes.
Perfect. Thank you. So in relation to the changes in the investment flows, I think, Santosh, you've already set the scene for us quite nicely with some of the slides that you had shared. So for me, to reiterate firstly that we have seen a significant uptick in global flows in virtually all the established and emergent asset classes in the last year. So where we might even have had, the concern that ESG flows might have dropped in the COVID crisis, and it actually has the opposite has happened. And we've seen that substantially across the asset classes. I mean, if I just look at the, the debt side and the bond market, it surpassed on every single one of the leading debt instruments, like your social bonds, sustainability bonds, and green bonds have all surpassed what the predictions were going to be. I think the other thing that has been highlighted quite strongly in the last year is that sustainable investments are actually a good business case. And so whereas we probably came out of a situation where as recently as 2 or 3 years ago, we're still hearing a lot about why it doesn't make sense to invest, and somehow the perception is that investing in relation to sustainability will diminish returns and cost money and doesn't give immediate sort of returns. We've seen that really being disproven in many instances in the last year. And should I say also that the focus and the spotlight on that has grown. So we're now finding the evidence that's showing the contrary. It's more easily accessible. There are more indicators and benchmarks and the like that are helping to prove that. So you know that in the first quarter last year, 2020, Morningstar had reported that 51 out of 57 of the sustainable indices that they were tracking had outperformed the broad market counterparts. So the benchmarks that we typically track were actually being outperformed by the ESG indices. And you could be forgiven for dismissing those results as a function of the record lows in oil prices, for example, because people would be saying that, oh, well, things like oil are typically not invested in by ESG funds. And so on the back of that, we saw better returns. But what we're actually seeing is that the analysis was showing that the oil indices, or the oil prices, were a small percentage, and the indices that excluded those were a really small percentage of the equity market value. And so the resilience of those ESG indices was actually determined by other factors, looking at the quality of the governance, looking at the way in which customers and employees were treated, and the financial health of the company overall. And so saying that a strong investment case actually defies some of these barriers that we've typically been seeing. If we look at another class, let's look at ETF flows. ESG ETFs sitting at around 22 billion and counting towards the end of last year, probably a lot more than that, 3 times higher than the inflows in 2019. So we're seeing this pandemic world, and then we're seeing record flows into these funds, which typically people, we're a little bit hesitant about. And then again, if we look at about 206 the sustainable open-ended funds and ETFs, the sustainable funds had outperformed in the first quarter, with 70%, between 60 and 70% ranked in the top halves of their respective categories and 44% in the top quartile versus 11% maybe in the bottom quartile. So not only were they outperforming, but the actual quartile that they were ranked in was higher significantly. So BlackRock also did some research, and they look at 32 widely analyzed and globally representative sustainability indices, and then their traditional non-sustainable counterparts. And they said upwards of 75% have outperformed. And more interestingly, when they track that backwards, they've outperformed consistently in times of crisis. So they looked at the last crisis that have occurred probably since as far back as the financial crisis, 2007, 2008, and saying that you could see this consistently over time, not just in a 2020 year, for example. So we're seeing that coming to bear. So if we look at the bonds, and I've mentioned earlier a little bit about this, S&P and Refinitiv data, that the combined issuances of the green, social, and sustainability bonds as the leading thematic bonds have really surpassed all of the predictions that we've seen. And also the biggest deviation from expectation was driven by the kinds of needs that we're seeing for capital in a COVID world. And the relevance of these instruments, I think, had come to bear quite strongly. So we saw that of the total issuances, about 40% were in green bonds, 29% around about there for social bonds. Social bonds, a big uptick in that time. And then the balance in the mix of sustainability bonds and other instruments. So if we look at that, the instrument value had just grown substantially, sustainability-linked loans being one of those that have grown quite substantively as well. The data on the continent in particular is a little bit harder to track, but the ones that we know about, with, Santosh, you've already alluded to those in your slides, so I'm not going to unpack those further. Similar data points in the likes of the AFDB and what we're seeing there, different markets now looking at using these frameworks, green bonds, drafting their own taxonomies, looking at their own frameworks. And so the rise of these instruments in sustainable finance overall has actually been very, very stark in the last year. And I think the use cases on a continent like Africa for those are quite clear, because those use of proceeds could be used to answer to a number of the needs that we're seeing in a continent like ours. And the fact that in many instances those issuances are also oversubscribed talks to investor demand to want to support those and want to bring those into their portfolios to meet their own mandates for ESG type investing. And in fact, today is quite an historic day in a way, because in Europe, the SFDR, which is the Sustainable Finance Disclosure Regulation, actually came into effect today. And there's going to be extraterritorial implications of those for continents like ours in particular. So I'm going to leave it at that for now, Santosh, and hand back to you.
No, thank you. I think it was a kind of a very good starting brief, I should say. And some of the things which you mentioned in terms of the kind of subscription that people are getting into some of these things has been, we have seen kind of the second tranche and the third tranche of the bonds coming out with the same institution looking at how the first tranche kind of performed as well. So I think there has been quite an eagerness with people who already experienced it. And I think it's time people have to just get started with. And once they get started, I think it's the same institutions which are going by. So is that something which is happening there as well?
Yes. Absolutely. So, there's obviously some hesitance, some of the hangover effect and the perceptions on, the fact that doing this is going to cost you money and it's not going to immediately generate returns. So some of these stats that I've shared with you are helping to dispel those myths and, give a little bit of buoyancy in the market and give a little bit more confidence in these instruments. Also, as you know, some of us are more hesitant unless we've seen examples of things happening. And as these examples are coming to bear in different markets, they're well documented. It makes it a lot easier to understand what you need to do and to be able to do that. So I'm also finding locally in the South African market, for example, is that where, things go very slowly at first and then they happen really fast after that. So you suddenly see the momentum being built in issuances. You suddenly see a slew of queries by listed companies who are saying, what is the sustainability thing? And what do we need to do differently? We've had investors asking us questions, and then you have investors coming to market to say, so what are you doing to enable investable instruments in this space? And then you're seeing this convergence of interest, which is really adding that dimension. And then, of course, the extraterritorial implications, as I mentioned, of regulation like in the EU, and I'm sure pretty soon in the US as well under the Biden administration, is going to have that knock-on effect in our markets. And so it's something we need to see. And again, I really feel that we've gone slowly, and we're suddenly going to see this kind of hockey stick trajectory, exponentially as we go into the next year or two.
Yeah, so I think that kind of leads me to the question, Imani, to you in terms of, this cross-boundary implications, what Shamila kind of mentioned in terms of this. You in your association with many developmental institutions, including the IFCs and the African Development Banks and all, you would have seen that they consider ESG for quite some time as part of their diligence process and all those things. But now I think going beyond them, the line of credit for most of the financial institutions in Africa would have an increased scrutiny over the ESG, right? So how do you see that kind of expanding? Are you already seeing that going beyond the developmental institutions and into any other line of credits as well?
Thanks, Santosh, and it's very nice to be here with both of you. It's always intimidating going after somebody who's in a market where so much is happening, like South Africa. I think you're completely right. The whole ESG drive started with the development finance institutions years ago. The IFC performance standards, which were adopted by the Equator Bank, were what made it more mainstream. Previously, especially the banks, but even the private equity funds, really looked at ESG as especially in Africa or in emerging markets, we need the DFI money, we have no choice, we have to do this compliance aspect to get their money. And then almost 20 years ago, the Equator Principles were adopted, and you had more than 70% of project finance in the world saying, we are going to use the IFC performance standards. And so that created the base for project finance. And then banks started saying, okay, this is normal. I think that today there's a huge change that's gone beyond the DFIs. So of course you still have the African Development Bank, CDCs, Propacos, IFCs are all putting in substantial money into emerging markets. You and Shamila talked about the green bonds, which were IFC. IFC did about $3 billion worth of social bonds since 2017. All that is still happening. But I think for me in the banking sector, what is really interesting now is to see the move from the global players, because they're basically saying when we are looking at ESG, and I think COVID accelerated all the risks beyond just the traditional environment and social. Inequality, diversity, social justice, employee welfare, all these risks came to the fore. But the really critical one, I think, is the recognition that we have less than 10 years to go to meet our obligations under the Paris Climate Agreement and under the UN Sustainable Development Goals. And so this has led to a huge increase. I mean, there's a plethora of banks, and not, the ones you would expect. Goldman Sachs saying they would spend $750 billion on sustainable finance in the next decade. Bank of America pledged $300 billion on sustainable investments. And this is not their CSR or sustainability team making these announcements. These are being made at the very highest level by their CEOs. So we are seeing the banks making very bold statements about moving away from fossil fuel-based investments. The DFIs had done this a long time ago. The World Bank Group says we won't do coal-fired power plants. So this had happened before, but now you're getting the real private sector. You've got the private equity players, and then you've got the asset managers. And the asset managers, Shamila mentioned BlackRock, but when you look at the trillions of assets they have under management and the fact that they are saying we are going to go towards net zero. So if you think about net zero, the bulk of their portfolios are in not very sustainable sectors at the moment. To move to net zero, you just picture the push of investment that has to go into the sustainable investments. And so this is what we are now seeing. Of course, it's having an impact on prices of what you call sustainable mutual funds, bonds, etc. And we have to be careful there isn't a bubble. But there's a huge demand and an opportunity, I think, for banks, especially banks in Africa, to look and say, well, these potential investors, especially the foreign banks who will give us credit lines beyond DFIs, right? Giving us credit lines, who will confirm our LCs, et cetera, they are asking us to be much more careful about our environmental and social management of our underlying portfolio. And so we need to do things to make us much more attractive.
Yeah, and many of the investors, now sounding more like a Greenpeace, or maybe Shamila, you are a trustee of WWF. I think it's kind of, I'm hearing kind of they're moving like an activist in the area of ESG, and that has kind of cross-boundary implications as well, because as you rightly said, Imani, when somebody says that we will be moving towards a carbon neutrality, and that's the pressure building upon every nation as well, in terms of their commitments towards a net zero. And naturally, any country which is committing towards net zero will have to apply it to the sectors of the industries in that country where they operate, which is again coming out as an investment risk as well. So I think it's a clear, multi-dimensional kind of a risk which is kind of coming together, and they need to protect their investments accordingly. So I think it kind of fits very clearly that this is the way forward, right?
I think you're completely right, but there are also opportunities. I don't want it to just I know as bankers, bankers are very risk focused, but there are also opportunities. There are a lot of new products coming out. You've got sustainable loans, you've got home improvement, climate friendly loans. You've got loans specifically targeted at women, millennials, carbon neutral banking products. I read something interesting where Enel, the energy company, literally issued a $4 billion bond linked to the SDGs. 10 years ago, if anybody had ever told us that a private company would issue an SDG-linked bond and it would be fully subscribed, we would have all said they were crazy. But this is where the market is going.
Oh, early 2020, you saw Alphabet's bond come out, and that was a big one. And every one of the green or the social bond or the SDG bonds, everything has been super subscribed, and I think that's a very clear indication. But giving this rise in this sustainable finance landscape, what's your view in terms of the challenges which the African banks or the financial institutions would be facing to partake this global momentum?
Okay, should I go? Okay. Well, they're huge. I mean, the challenges are huge. I think on the one hand, the focus of Paris and the SDGs has provided clarity on what does sustainability look like. And so as an institution, when you want to say, let me assess the risks in my portfolio, you have a framework within which to do that. So that is positive. But financial institutions, they need to be commercial. They need to make money. So there are a lot of, when you're making a decision in terms of portfolio allocation to go more green, you really have got to look at what I call transition risk. You can't just put a stake in the sand and say, I'm going immediately and we're changing everything, because you have to balance your portfolio. So you really need to think about that. There's also a big risk of not understanding what you're undertaking. People call it greenwashing sometimes when you do it very cynically, where you just say, you make a big announcement which you either have no intention of living up to or you had no clue what it was you were committing to. And nowadays, the scrutiny on commitments that companies, especially financial institutions, make around sustainability is very high. I think one of the really key things that everybody struggles with, not just financial institutions, is disclosure and reporting. If you take a bank, you've got your regulators. So you've got the central bank, you've probably got your stock exchange if you're listed, you may have the Securities and Exchange Commission. Here in Nigeria, we've got the Financial Reporting Council. If you have money from DFIs, they have their own reporting requirements. If you have GDRs listed. So it's a plethora with no standardization. A lot of people recognize the need to standardize and they're trying to improve. And there's a network for greening the financial system, which is made up of supervisors and central bank governors, which is looking at how can we standardize. You've got the the TCFD, which is the Task Force on Climate Related Financial Disclosures, which is also looking at how can we standardize. So there's a lot going on, but even as a financial institution, how do you get the data, right? Your own footprint is easy, but from your portfolio and from your clients to be able to say, I can disclose. So I think reporting is going to be a huge, huge issue. Capacity, another big one. And, at the moment, there is a demand for people who understand sustainability and sustainability-related issues globally. To be honest, why would somebody say, I'm going to come to an African financial institution where I'm fighting with the MD and fighting with the board to persuade them that this is important, when I can go somewhere where there's already a bit more traction? So I think as African financial institutions, we really need to make sure that at the highest level, we commit to this so that we can get the expertise in. I'll stop there.
Okay. No. So I think one of the indications which you gave is on the reporting per se, and maybe that would be my cue to go to Shamila as well. I think with the King's recommendations and the commission, you in South Africa, you people have been a little ahead of the curve in terms of the ESG reporting. And maybe what is your experience? I mean, Imani talked about the challenge in terms of reporting the non-availability of the data and the accuracy or reliability in terms of the ESG data which comes out, how much you can kind of rely in making those investment decisions and all those things. But as I said, you in South Africa, you have been ahead with all those corporate governance recommendations and the regulations which came in quite early. Are you seeing a kind of a big change from the period at that time to now in terms of improved disclosures, improved reliability that can be placed on those disclosures? What are you seeing?
Yeah, thank you, Santosh. So it is true that I think the South African market in many instances has actually been world leading because of the governance structures within the country, and that have been held up over time, I think, and upheld, should I say, over time. I can speak obviously from a public markets perspective. The JSE has enshrined the King Codes in the listing rules, and the King Codes are recognized as being world leading in relation to governance standards. And so, unlisted companies, have to do King on an apply and explain basis. But within that, there's a lot of flexibility because what we don't do is prescribe which framework, which standard, how you need to do that. And that's where the role of governance, I think, comes in very, very strongly. And so there's absolutely no getting away from the fact that the role of management and the board is critical in applying its mind to being able to understand these challenges, to be able to see what's coming in the same way that it would do for any risk, any opportunity in any part of its business. And so applying its mind in that way. Of course, the second level, is the issue of standards, is the issue of disclosure frameworks and the like. And so while we haven't been prescriptive, we've left it up to the company to decide how it has applied its mind to what its risks are, what is critical to it, and that it could use a variety of frameworks in order to be able to disclose. Now, it was very difficult if you think about needing to try and do this 5 years ago. If we were to prescribe, for example, what disclosure standard you needed to do, which one would we do? There were a plethora of them. And then how does the JSE decide one over another as being the right one? So what we said is that the guidance is that you need to consider these things explicitly, so it is very clear, and it set the tone that these things needed to be considered. But how you do it, obviously, is sitting on the fiduciary responsibility in your board. And secondly, what disclosure frameworks you use would then be dependent on how you have considered what those risks are. We're in a situation now where further down the line, we're a lot closer to global sort of convergence and agreement on standards. And so if we look at some of the developments that have happened literally in the last year, it's been tremendous. So we've seen the IFRS Foundation, the Financial Reporting Standards Foundation, come out with their proposal looking at setting up a sustainability standards board. And in my mind, that's probably the one that's got the biggest punch, right, because of the stature of the IFRS. And then we've seen the Institute of Securities Regulators, IOSCO, supporting those efforts and looking at those. And then, of course, we've seen that IFRS Foundation is pledged to work together with the existing leading sustainability standard setting bodies to be able to work together. So I think while it's completely a valid criticism that data has often not been standardized, not always been decision useful, and certainly not always been consistent, there's a push towards that regard. In markets themselves, where there are, for example, ESG ratings at play, for example, for inclusion in indices, we've got FTSE Russell doing ratings, MSCI does ratings, Dow Jones does ratings, Sustainalytics and the like. Those themselves have had the effect of guiding disclosure in a way, because often what those are doing is that they're reliant on the public disclosures of the companies that they're assessing, and so they themselves have worked on that. Now, usually underlying those is a reference to different standards. So you would find that there's quite a strong reference to the GRI. So beneath that, you often do find that there's a level of convergence to, you can expect if it's human rights, these are probably at least the 5 things that are going to be asked. If it's climate change, these are at least the 6 things that are going to be assessed. And so that's where we're starting to see that one needs to understand those frameworks, what they're aiming to achieve, and therefore what is relevant to your organization to tell its value creation story in the best possible way, to assess its risks and to assess its opportunities. So that is, for me, very critical, is that there's no getting away from that responsibility. There is a skill set that's required to understand those. In the IFRS Foundation's proposal, for example, you would see that some of the comments have been alluding to needing to ensure that the right skill sets are brought to bear in the governance of the Sustainability Standards Board itself. Because, if accountants, for example, who is the typical remit of IFRS, are deciding that they're going to decide these standards, we potentially put ourselves into a bind where we're not necessarily going to have the full understanding of what these issues are. Now, Imoni mentioned, for example, the SDGs as being such a critical issue because the SDGs are giving us a North Star to map to. They are time bound because, we've got till 2030 to look at that and time's running out. And we know, the cited numbers are like a $2.5 trillion annual funding gap to meet the SDGs that are not going to be found by governments that are reliant on the private sector to be able to make those moves. So how are the standards working towards an outcome is, to me, what we need to apply our minds to. And where do we need to reference to be able to make that decision useful information and actually have the impact that we're intending to achieve? So for me, it's the governance around that. It's the understanding. It is the responsibility sitting at the board level and management to do that. And of course, understanding then that these factors at play globally could in reality end up in a bank's case, for example, with you facing stranded assets. And it might not be because the legislation in that country actually precipitated it. It could be global pressures that have actually resulted in that because you're suddenly seeing this move away from those things. And Santosh, if you want me to speak a little bit about divestment, I can do that. Let me pause there and see if you have any other questions on this issue of standards and disclosure.
No, I think you covered it pretty elaborately, and when I look into it, I think you touched upon the financial professional as well, and suddenly it got me reminded. I think it was a book written by King himself where he said that how the CFO would be the chief value officer. And I think that was the book which came to my mind. But one of the questions which has come in as well is related to how do you assess the impact of the regulation to move into sustainable finance in Africa, and which I think is important. But I think how do you see the kind of role of this regulation now picking up? Because as KPMG, we publish, I think once in 3 years is the period now. We call it as the carrots and sticks. That's a publication which we bring out. We kind of look into the global regulations around sustainability. And we have seen the increase in terms of regulation. But I'm quite sure that 2020 onwards, the kind of regulation will be fast-paced. We are seeing it right now. Our Securities and Exchange Commission, Exchange Board of India, is coming out with various regulations as well. How do you see the pace at which the African regulation is going to go?
It's a difficult one. It's a difficult one to call from my end, so I'll just give a quick comment on that, Santosh. It really depends, I think, on how those markets are seeing these things impacting them. And here I think I want to highlight the fact that we mustn't see ourselves necessarily just as takers of what's going on. We have a strong role to play in shaping that. Each of us in different markets have a role to play in ensuring we understand where those conversations are happening and how we can be a part of that, bringing to bear whether it is the fact that we need to push regulators in our market to be aware of what's going on and what's potentially at risk if we don't move in line with what's going on globally. And at the same time, to be able to make input to what is going on globally, to say, as a continent, for example, there's things that are challenges that we face, and we are working towards that, and we have a plan, and we therefore want to work with other regulators to understand that context and then to bring the continent into that conversation. So I think for me, it's going to be about saying how aware are we of this. I do think that the rate that it's going to happen is going to speed up out of necessity and being pushed by what's happening elsewhere. But I think it's also an opportunity for us to be proactive, to shape those conversations. I mean, in South Africa right now, there are heated conversations going on around things like transition and the just transition. We're a coal-based economy. We still get 90% of our energy from a beleaguered entity that is providing that energy into the country. And so there's serious issues for a country like ours. Yet at the same time, we know there's huge pressure to bear to transition rapidly. So what then is the role of business at large, of civil society? How do we get together and facilitate that conversation to be able to drive the right policy, the right regulation, the right incentives in our markets to be able to understand this. So understanding what's happening globally, being a driver for change in your own market, and being able to understand what those implications are, otherwise risk honestly being left behind. And I don't think that's just unique to Africa. I think there are many other countries that are in a similar situation. And so, it is an opportunity for us to be proactive in that space.
Right. So I think, Imoni, the same question to you, but do you see, a kind of that proactiveness, if it is lagging in some of the countries, it might impact on a run in terms of being competitive to attract fund flow? Will that be a kind of a right manner I should take this, that the more you delay in terms of bringing out some of these policies and regulations and all, you are going to be less competitive in attracting capital?
So, I mean, I think you've got to look at it at different levels. So there's the country level, and Shamila talked about what South Africa is doing. Across the continent, all our countries made commitments under Paris. Some of them have not fed through. But then you look at a country like Morocco, which has just been completely aggressive in saying it is going to meet its goal of 52% renewable energy mix in its energy sector. I think it's by 2030. Completely aggressive. And so it's putting in place policies to make sure that that is achievable. I think a lot of the so you've almost got to split the financial sector, and sadly the banks tend to be the laggards. The private equity space, I think, has moved the most, and that is primarily because the private equity space attracts international investors. So they're very, very focused on making sure that they're looking at longer term risks, they're looking at opportunities to add value. I mean, by the nature of private equity, that's what you do. You invest, you want to add value, then you want to sell. So I think in terms of the focus on sustainable finance, the private equity space has been at the forefront. And I think when you look at most of the GPs around the continent, they can access funding in spite of the difficulties, and they're fairly on top of these things. Then you look at the insurance sector. Obviously, they've been slightly hit, so the insurance sector is also looking at it. But a lot of the other sectors tend to follow what the regulation is doing. And the African regulators are still getting, outside of South Africa, Morocco, maybe Egypt, are still getting up to speed on what is happening. I mean, you even look at things like data privacy. I know it's not, specifically climate or environment focused, but, we only got, data privacy regulations on the continent in the last few years following the GDPR. And we took the GDPR and said, let's adapt it because we know that we're going to be needing to interact with European entities. So I do think there will be an element of being laggards. And then I don't think we should, we shouldn't make excuses. But the reality is that over the last year, a lot of our African governments have been focused on surviving. COVID has hit us really hard. It's been the health of our populations. We're still seeing how we can get vaccines. So we know this is important, and companies know this is important. But I do think that the commitment may be a little bit slower than elsewhere just because of all the pressures. There are positives in the inclusive finance space, gender, sector specific, agri, those kinds of types of investments where you see a lot of the central banks actually putting in place risk-sharing mechanisms to try and push investments into those sectors. I think that will continue. But I do think it's going to be a bit of a challenge, especially 2021, as we focus on trying to get out of COVID.
Mm-hmm. And you're true. I mean, we are also seeing in terms of the agriculture, I think, sustainability linked loans are kind of very clearly coming out very clearly. And it's interesting you mentioned about the PE side of the things. And, we have some examples where we say that the private equity is planning or planning in advance in terms of an exit strategy, and they are looking into companies whom they would exit through an IPO to very clearly bring out the ESG value upfront. And I think slowly people are seeing that even in an IPO kind of a scenario, you require to have that ESG credentials for you to kind of get into the mainstream investing. And so I think we are seeing the private PE space kind of looking into the ESG quite a bit. But it's true for the private banks as well. I would say in terms of the public sector banks, still that transition phase is something which they have to handle, because as a country, you cannot suddenly decide that you exit from a particular portfolio. So there need to be that transition phase which need to be done. So that is something which we are seeing in terms of the public sector undertaking slowly kind of coming and stepping into the transition phase. And so as you rightly pointed out, that's going to be an important space in terms of the transition. How would that play? And I know that, Shamila, you also mentioned that it's going to be very important in terms of that transition for you as well as a country. So what role do you think the financial institutions can play in the transition as well?
Okay, so Santosh, the financial institutions have a very important role to play in transition. The first thing would be to understand what that transition needs to look like in the main markets in which they play. Because transition can be a bit tricky, right? And transition is a relatively new term in the sustainable finance space. And we only saw, for example, the ICMA handbook, I think, came out in December, if I'm not mistaken. And then we had CBI also come out with some guidelines recently. So when we look at what is codified, for example, within there, or what the recommendations are, it's really saying for something to qualify as transition finance, for example, it needs to be following a very clear view as to where that entity is going. So if you're coming to market to ask for capital and you're labeling it as transition to enable your transition to a greener end and maybe to net zero, you have to have mapped out a clear path as to how you're going to get there and what you're going to do along that timeline. And that needs to have credibility, and you need to have proper measures in place, right? Because you're going to go to the market asking for this capital and you're labeling it as transition because it's not yet green, it's still transition. And you're saying, I'm going to get there, but help me now make my current portfolio slightly less brown, maybe not even green yet. And so understanding that is going to be critical. The context is going to be critical. Knowing how anybody else is defining, for example, what net zero needs to look like is so important. And the investors that you're seeking to attract with that issuance, for example, going to agree with your version of that plan. So there's a lot of devil in the detail, and financial institutions are going to have a role to play to start, I think, sifting through that, making it clearer, coming up with their own guidelines, where they're playing an enabling role in that finance spectrum, and being able to say, well, this is what is generally acceptable. This is the boundary within which we sort of need to operate to be credible. And of course, there are risks with transition, right? Because it really should be very time bound in a certain period of life. And in all likelihood, it will be governed by what the Paris objective is. By net zero 2050, try to keep to 1.5 degree world. Those sorts of things are going to be the boundaries most likely that we need to operate in. And then translating that into actions, translating that into the proper disclosure, the right planning, the tools and the benchmarks that you need to use is where the financial sector is going to play a large role. Understanding those scenarios at a local level and how they relate to a global level. And here I'm sort of also bringing in the conversation around disclosure. And if you look at the TCFD, for example, and the recommendations that they have in place, that is going to, it's largely becoming the de facto disclosure standard for climate change, right? So if you look at that and say, in this context, how do I balance these different needs and make my case strongly and understand that, I think gives you a strong sense that the entire financial sector needs to work together to agree on what that needs to look like, so that it can actually enable the right financing in its context. And context, again, matters hugely. Local context, but how that local context relates to global goals in order to maintain credibility, and I think to attract financing at the levels that we undoubtedly need.
Yeah, I think we discussed quite a bit about the external environment, and maybe, Moni, I would like to kind of bring in as an institution in Africa. What are the things which you need to kind of internally also look to leverage upon this opportunity which is there? I think you touched upon competence a little while ago, but I think more as an organization, how do you kind of build yourself to kind of capture this opportunity?
So I mean, Sharmila talked about leadership at the board level. That is so critical. So it's the board and management. I mean, that's really where it starts, because that's where your strategy comes from. You can talk about the regulation, etc., but as you say, that's all external. You as an institution know where you want to go. So you know what your strategy is, and then you really need to, I think we all need to have climate-friendly strategies. That's the reality. There is no point sitting in Africa today as a financial institution and still planning to be in oil and gas. Or, if you're looking at tourism, right, with the climate coming down, where are you going to be? Or agriculture, you really have got to take a very hard look at your local context, the potential climate impacts. And then we talked a lot about climate, but there's also the whole societal Black Lives Matter. I know it's primarily the US, but the whole concept of inequality and diversity. We had the EndSARS protest here in Nigeria. These are local things that are happening. We just had protests in Senegal this week. We really have got to understand our context of our stakeholders, of our businesses. And then once you do that, and the board is completely aligned on the strategy, build capacity at the board level, and then management, and then you start with the institution. You can work with your regulators. I actually think that in Africa, a lot of our regulators are actually asking, they're waiting for the private sector to lead. They're actually saying, you tell us. If you tell us you want to do this and it's credible, we will support. And the key thing is for us to start thinking much longer term, right? And then really, really start building the capacity to bring our stakeholders along. The potential funders, right? Both our shareholders, providers of credit lines, debt, our depositors, they're also just waiting for us to tell them, right, that we are institutions that they really can trust to do the right thing with their money.
Well, thank you. I think it kind of gives a kind of a, it all starts at the top. We all know that. I mean, it's what sets the organization apart, the kind of leadership and what you bring to the table as well. And in terms of the way forward, there is only a northward direction in this sustainable finance. So I think there is not, you know the direction very clearly. And as I started my slides by saying that it's kind of the gray rhino, coming to you. It's not anymore a black swan. And I think what we try to do during this discussion is also saying that there is enough opportunities, enough drivers out there to be capitalized. And I think that's going to be the trend in which the world would be moving. This is just the start. And we are kind of moving into a direction where almost I think we are across the tipping point. I think it's just going to be a business as usual scenario on ESG for every investment which would come in. So I think the early movers will have the advantage. I started by showing a picture of a wave, and I would say ended by saying that when you want to surf, the earlier you get on the surfboard and earlier you get onto the wave, the longer you can surf. But in any case, the wave will take you to the shore. So if you didn't get it early, by tumbling and rolling, it will take you to the shore. But in any case, you'll reach there. It is up to you to decide whether you want to take the early route and get on the board early and surf it properly, or by tumbling and rolling, you need to reach the shore. So I think the objective of this session was to kind of clearly bring out the opportunity perspective for the African financial institutions to get ready for or get on board with the ESG wave and the sustainable finance landscape which is evolving. And it's our sincere hope that we have created that level of interest with the people who are here listening to us. And so thank you very much to both of you. I think it has been very interesting, the discussion. And I felt like, we still have some time, but I just noticed that we have very little time now. So thank you all. Thank you all who have been listening. And, it's kind of together, we would make a better tomorrow. And let's hope for that. Thank you all.
Thank you very much. Bye.
Thanks, everyone.